Imagine you finally have the perfect plan to start that small business you've been dreaming about. You just need a little extra cash to get it off the ground. So you head to the bank. Let's say you checked the numbers last year. For this exact loan, the bank was charging a 5% interest rate. Very affordable. But you walk in today, ask for the exact same loan from the exact same bank, and suddenly they want 15%. Nothing about your business plan has changed, but overnight, that money has become incredibly expensive to borrow, and your dream suddenly feels out of reach. It leaves you wondering, why did the exact same money suddenly get so much more expensive? And who actually gets to decide that number? Welcome back to episode 5 of The Money System. To find out who is pulling the strings at your local bank, we have to look at the global economy. In our last episode, we saw how governments print new money to support the economy during difficult times. But we also saw the consequence of doing that. When too much new money floods the system, you get inflation. The prices for everyday goods start rising faster than our wages. If printing money causes prices to rise rapidly, the government needs a way to pull those prices back down. This is where interest rates come in. Simply put, an interest rate is the cost of borrowing money. Think of it as a price tag for renting cash. When you take out a bank loan, you don't just hand back the exact amount you were given. Let's look at a simple example. Say you borrow exactly $1,000 from the bank. If the interest rate is 10%, you eventually have to return $1,100. That extra $100 isn't a penalty. It is the profit the bank earns for letting you use their capital for a while. Now imagine the ripple effect across the entire country when that rental price goes up. When loans become expensive, people naturally hesitate. They might hold off on starting a business or delay buying a new car or a house. This shows what happens next. Because millions of people are making that same choice, overall borrowing drops drastically. And when borrowing drops, spending drops with it. With fewer customers spending money, businesses can no longer aggressively raise their prices. This chain reaction is exactly how raising interest rates successfully chokes out inflation. But what happens in the opposite scenario? What if interest rates are slashed to very low levels? Suddenly, renting that money feels very cheap. Taking on a loan feels like a much safer bet for the average person. People realize they can easily afford the monthly payments. They secure mortgages, open up shop on new business ideas, and start spending freely. This collective rush causes overall borrowing to surge, pumping new spending directly into the market. That surge of cheap, accessible money acts as a powerful engine, helping a slow economy start growing again. If the financial system is a vehicle, then interest rates are the speed controls. High rates act as a heavy brake pedal to cool things off, while low rates act as a powerful accelerator to speed things up. The drivers behind that wheel are central banks. They are the institutions keeping their feet on these pedals. Their job is to constantly tap the brakes and hit the gas, working to keep inflation, maintaining economic growth, and overall stability and balance. While these decisions happen at towering central banks, they dictate the reality of your daily life. Every time they adjust that dashboard, they change the cost of your personal loans, the yield on your savings accounts, and even the availability of job opportunities in your town. When rates go up, life becomes more expensive to maintain. When they go down, money becomes easier to access. Because they dictate how much people borrow and spend, interest rates are the most powerful tool for controlling how fast the world's economy grows. Now that you understand how interest rates act as a speed control for the economy, the way the money system moves starts to make sense. But even when central banks balance the economy perfectly, the physical cash in your pocket still inevitably buys less and less over the years. Why does currency naturally lose its value over time? In episode 6, we will break down exactly why your money becomes weaker.